The headline says record highs. Again. The S&P 500 and the Nasdaq both closed at fresh all-time highs today. But scratch the surface, and today wasn't really a story about strength. It was a story about who's still buying and who's quietly running out of money. Let's get into it. Start with the tape. The S&P 500 added 44 points, up 0.58%, to a record close of 7,563. The Nasdaq did the heavy lifting, climbing about 235 points, up 0.91%, to a record 26,917. The Dow was the odd one out, essentially flat, up just 27 points, or 0.05%, at 50,669. What's interesting is how we got there. Stocks actually opened lower this morning. Oil was climbing overnight after fresh U.S. strikes near the Strait of Hormuz, and for a few hours the market was in the red. Then the mood flipped. A strong forecast from software company Snowflake reignited enthusiasm for the AI trade, and a reported agreement between U.S. and Iranian negotiators to extend the ceasefire pulled some of the risk premium back out of oil. By the close, tech was firmly back in the driver's seat. But here's the part that record headline buries. This morning brought the Federal Reserve's preferred inflation gauge, and it was the hottest reading in nearly 3 years. Headline PCE came in at 3.8% over the past year, up from 3.5% the month before, driven largely by the oil shock from the Iran conflict feeding straight into gas prices. Core inflation, which strips out food and energy, ran at 3.3%. And underneath the inflation number, the consumer is starting to buckle. The personal savings rate fell to 2.6%, the lowest since June 2022, as households dip into savings just to keep up with prices. Real disposable income actually fell. And first quarter economic growth was revised down to 1.6% from an initial 2%. So the picture is an economy slowing, inflation re-accelerating, and a consumer reaching into the piggy bank. That is not a backdrop that screams record highs. For the Fed, that's a trap. Inflation, this hot, takes rate cuts off the table. Traders are now betting the central bank's next move could actually be a hike early next year, not a cut. And Wall Street is starting to notice the disconnect. Strategists at Bank of America told clients this week to start preparing for a summer pullback after what they called a relentless rally. Add it to the warning signals column. Which brings us to the after-bell headliner. Dell reported earnings after the close, and the numbers were staggering. Revenue of $43.8 billion, up 88% from a year ago, and well past what Wall Street expected. The engine? AI-optimized servers. That business alone brought in $16.1 billion, up 757% from a year ago. Dell raised its full-year forecast for AI server sales to $60 billion, and the stock jumped more than 25% in after-hours trading. Separately, Dell also landed a 5-year, roughly $9.7 billion software contract with the Pentagon this week. A real government win, though that one's a Microsoft licensing deal, not part of the AI server story. The contrast with Costco was sharp. Costco beat on sales, up 11.6%, but came in just light on earnings. And on a stock priced for perfection, the reaction was a shrug. Shares barely moved. So step back. The market is throwing a party for the AI build-out, and Dell just proved that demand is still accelerating, so that party is real. But it's happening on top of a consumer draining savings to pay for gas, and a Fed with no room left to cut. Records on the screen, strain in the data. The further those two drift apart, the more record high describes the headline, and not the market underneath it. We cover the markets on the days that actually matter, with explainers when it helps. Hit subscribe so you don't miss it. We'll see you next time.